So, um, now let's talk about Forex trading sessions. One thing that makes the Forex market unique is that it operates 24 hours a day. But even though the market never really sleeps during the trading week, different parts of the world become active at different times. And that's exactly what Forex sessions are all about. You can think of the market as being divided according to the major financial centers around the world. As one region becomes active, trading activity starts increasing in that session. Now, there are four major Forex trading sessions that traders pay attention to. We have the Sydney session in Australia, the Tokyo session in Japan, the London session in England, and the New York session in the US. An important thing to understand is that some of the busiest periods in the market happen when two sessions overlap. During these periods, trading activity tends to increase because more participants are active in the market at the same time. Also, when a particular country's trading session is active, its currency can sometimes become stronger because that region's economy and financial markets are more active during those hours. However, that's not always guaranteed because market movements are also influenced by technical and fundamental factors. So, understanding forex sessions helps traders know when the market is likely to be more active and when trading opportunities may be easier to find. All right, let's move on. Slide two. Okay, so now let's look at some of the major participants in the forex market. One of the most important groups is known as the interbank market. The interbank market is a global network where very large financial institutions trade currencies directly with one another. Instead of going through a retail broker, these institutions transact at a much higher level. To facilitate these transactions, they commonly use specialized brokering platforms such as EBS, which stands for Electronic Broking Services, and Thomson Reuters. Now, this level of the market is generally reserved for the biggest banks in the world. These institutions are sometimes referred to as flow monsters because of the enormous size of their transactions. We're talking about trades involving billions of dollars because these banks trade such large volumes. They account for a significant percentage of all forex market transactions, estimated at around 60 to 80% of overall market activity. Some examples of these major institutions include Bank of America, HSBC, Citi, JP Morgan, UBS, Barclays, Deutsche Bank, and Goldman Sachs. So, when we think about who has the biggest influence in the forex market, these large financial institutions are definitely among the key players. All right, let's continue. Slide three, spot price, bid price, ask price, and spread. All right, now let's discuss some of the most important pricing terms you'll see in Forex trading. The first term is the spot price. The spot price is simply the current exchange rate at which a currency pair can be bought or sold in the market. In other words, it's the quoted market price that traders see at any given moment. Next, we have the bid price. The bid price is the price at which a trader sells. Then we have the ask price, which is the price at which a trader buys that currency pair. Now, the difference between these two prices is called the spread. The spread is calculated by subtracting the bid price from the ask price. This difference represents the charge that the broker earns for facilitating the trade. So, when you place a sell trade, the transaction is executed at the bid price. And when you place a buy trade, the transaction is executed at the ask price. Understanding these four terms, spot price, bid price, ask price, and spread, is extremely important because you'll see them every time you analyze or execute a forex trade. All right, that's it for this lesson. In the next lesson, we'll continue building on these concepts and explore more of how pricing works in the forex market.